While iron condors offer a statistically higher win rate, the iron butterfly captures nearly 3x the max profit for the same margin, but it comes with a hidden gamma trap you need to understand. Both strategies are defined risk, neutral trades designed to profit from time decay and volatility contraction. However, the structural difference in how you place your short strikes changes your entire management style. The iron condor creates a wide profit plateau by separating the short call and short put. This structure prioritizes probability of profit over total return on risk, giving the stock room to wiggle. Conversely, the iron butterfly forces the short call and put to the same strike, usually at the money. This collapses the profit zone into a tent shape, sacrificing win rate for a massive potential credit. Visually, the difference is stark. The condor is a forgiveness strategy. You profit if the price stays somewhat near the middle. The butterfly is a precision strategy. You profit most if the price pins exactly at the strike. Let's look at the trade-off. A standard iron condor might offer a 70% probability of profit, but a 1 to 3 risk-to-reward ratio. You are risking $3 to make $1, banking on the high probability that the market stays quiet. The iron butterfly flips this math. Because you collect a much larger credit up front, your risk-to-reward is often 1:1 or even better. However, your probability of profit drops to around 50% or lower. This brings us to the break-even calculation. In the iron butterfly, the credit received is essentially your shield. The wider the credit, the wider your break-even points become, effectively creating a synthetic width. But here is the critical nuance most traders miss. The Greeks behave differently. Specifically, gamma risk is much higher in an iron butterfly as you approach expiration. Because your short strikes are concentrated at one point, price movement against you hurts faster. This is negative gamma. In a condor, the separation of strikes flattens this curve, giving you more time to react. This leads to our first major decision rule: management intensity. If you cannot monitor the market daily, the iron butterfly is dangerous. A sudden move can wipe out profits instantly due to that gamma spike. Conversely, the iron condor is more forgiving of passive management. You can often set alerts at your short strikes and walk away, knowing the body of the trade buffers you from small moves. So, when do we choose which? We use a flow based on implied volatility, IV, rank, and the market's expected move. High IV environments favor the butterfly because the credit received is massive. When IV is high, the premiums are juicy. The credit you collect on an iron butterfly can be so large that your break-even points actually become as wide as a standard iron condor. We call this the break-even comparison test. If an iron butterfly gives you the same break-even width as a condor, but with higher max profit potential, choose the butterfly. However, if the market is trending rather than range-bound, the iron condor is superior. You can skew the condor, slide it up or down, to accommodate a directional bias while still collecting theta. Let's talk about exit strategies. With iron condors, we typically aim for 50% of max profit. Once you hit that, the risk of holding for the remaining pennies isn't worth the gamma risk. For iron butterflies, the target is usually lower, around 25% to 30% of max profit. Because the max profit number is so high, 25% of an iron fly is often more absolute dollars than 50% of a condor. A common mistake with butterflies is pinning hope. Traders hold through expiration, hoping the stock lands exactly on the strike. This is gambling, not trading. Always close or roll before expiration week. Rolling defense is also different. With a condor, if tested, you roll up the untested side to collect more credit. With a butterfly, you are already tight. Your only real defense is to roll the whole structure out in time. Let's summarize the decision matrix. Use iron condors for lower IV environments, passive management, or when you need a high win rate to build psychological confidence. Use iron butterflies in high IV environments, earnings, binary events, or when you are active enough to manage the gamma risk, aiming for a higher return on capital. Ultimately, your choice defines your trading personality: the steady accumulator, condor, or the aggressive volatility seller, butterfly. Choose the one that lets you sleep at night. Master the Greeks before you trade. See our decision system playlist next.